Well, after a solid bull trend since early January, are we seeing the tech trade starting to deflate? We see concerns around coordinated rate hikes resurface as we see bond yields, both on a nominal and a real basis, starting to move higher again. And gold is starting to look a little bit dicey. The tides of change could be upon us. We need to be prepared. This is the trade-off. Well, hi, I'm Chris the Poet Weston. I thought I'd mix it up a little bit in the synopsis. We'll see what happens there. I'm going to bring Mr. Blake Morrow into the programme. Mr. Blake Morrow, how goes it there?
I'm just thinking, winds of change or a sea of change?
I wanted to go a bit longer, to be honest, but then I had to stop and I just couldn't think of any more, to be honest. So my poetry seems to be leaving me. But yeah, how's trading going for you at the moment?
You know, it's choppy. It's choppy. It's directional. It's, very little volatility. But I think that's going to change with this sea of change that we have coming on, don't we, Chris?
It'd be nice, wouldn't it, if we could see a little bit more coming through. And, for us, FX heads out there and also index traders, I think, if we do see interest rate volatility start picking up, there's no doubt in my mind that will spill over into our sort of core asset classes that we change. A bit of movement, a bit of trend, a bit of sort of range expansion. Never hurt no one. So yeah, it'd be nice if we saw that pick up. Anyway, I reckon let's go straight into topical thunder and see what the factors are that could cause this potential volatility. Let's go into topical thunder. Well, I hit it straight out the bark. Well, let's go straight into the rates market there because. Yeah, a couple of days ago, we've seen recently the RBA surprising once again with a rate hike and guiding to more. We've got, I think, about 10 basis points being priced in for the July meeting. So, that's a live meeting in the market's eyes, although we have a raft of data that we still need to sort of get before we get that July meeting hike. Obviously, we saw the Bank of Canada coming out last night. I think 8 of 37 economists were calling for that 25 basis point hike. So, it was out of consensus, although the swaps market was pricing about 40%. But yeah, again, they've kind of guided to more and said that they're inflation may be outside of the target for some time and meaningfully above that level. So the concern now is that of these kind of pause central banks are renewing hikes, perhaps it could be somewhat coordinated and perhaps we could see other central banks looking to be more aggressive as well. So we have seen bond yields moving up and then that's deflated the tech trade. Big selling through in the NASDAQ. Yeah, big bearish outside day reversal, which we'll come to. Bit of switching back into sort of banks and certainly regional banks as well. But yeah, are we concerned, Blake, here that we're going to see renewed tightening playing through in markets and that's going to cause gyrations in risk assets?
I was wondering today, after the Bank of Canada surprised with the interest rate hike, that it might weigh on equity markets. I don't think that was specifically it, but maybe it was a culmination of things that, that actually ended up weighing on the equity markets. But, when you talk about like the tech sector and, I know last week we were talking about the NASDAQ, potential reversal in the NASDAQ 100. I know a lot of people have been discussing the tech dominance kind of reversing here. I think it's important to note, like you look at stocks like Apple, following that release at the
Vision Plus or Vision Pro.
Yeah, at the tech conference.
Are you going to get one? Are you going to get one for $3,500 over it?
$3,500.
Jesus, it looks sexy though, doesn't it? It looks bloody good.
It does look cool. I watched a review on it. They say it's really heavy. My younger son or my oldest son, he's had a couple VR sets, and I enjoy it. I actually enjoy the experience. But anyway, but I don't think it's going to be mainstream enough. Let's just put it that way. It's at this price. And the first iteration is probably not going to be.
If your kids ask for one for Christmas, you'd be like, "Oh, what have you done well for me this year?" Right. It's a punchy request, isn't
it? Can we sell your vehicle and maybe we'll do that?
yeah, sure.
But the fact of the matter is we saw a really big reversal in Apple. And that's been one of the big leaders of the market. We saw the island reversal in NVIDIA. We talked about it at the end of the trade-off last week. So this reversal that we're seeing in these tech stocks, I think is worth noting, and I think it could be a catalyst from rate hikes. And I think you're nailing it here.
Well, I think
this wasn't.
Go on.
I was just going to say this was a big issue for tech stocks initially when the Fed started lifting off, and other central banks as well.
Well, I think I just want to go into CPI in a second. I'll let you introduce that, but I think the 5-year real rate, or the Treasury inflation protected security, is breaking out to the top side now. That has big implications. The real cost of capital is going up. If we were to see a stronger dollar and a one-way trend in the dollar, I think that would cause big moves to the downside in risk. But we're not seeing that at the moment. But I do think that we want to keep attention onto real rates and also the front end of the Treasury curve and various bond markets, because if this moves higher, I think risk is going to be under pressure. We took profits that last week on the long Nasdaq shorts, Russell shorts, risk trade, and that was a good timing.
Perfectly timed.
And I think there's more juice in that. So I'm a bit concerned about tech at the moment, but we're watching that front end of the bond market there.
All right. Well, let's turn our attention to. I really wanted to talk about CPI and PPI. That's because we're going to be dealing with it early next week before we film. So by the time that you guys and gals catch us, you're going to be catching us on the flip side of that data. And I want to ask, how important to you, or forget that, Chris, scratch that. Producer, can you just how important is it to the Fed and the FOMC and their rate decision, come Wednesday, the CPI and PPI data that's coming out. I know we're going to talk about the Fed and we're going to talk about the FOMC here in a minute, but as far as inflation, what are you looking for, and how are you going to play it? I mean, the dollar it's pretty well bid, and I mean, CPI, what are we looking for next Tuesday? We're looking for year over year 4.1%, coming off of from 4.9%. We see all these disinflationary pressures. How about if the number comes in line? Are you going to be a dollar bull? I mean, I am. I'm looking at the dollar, and I'm just looking at it going, I think there's a lot of different ways to play the dollar as a whole, whether it's short euros, buy dollar yen, which is holding well above 138.
You like dollar yen? Dollar yen looks good.
Yeah, I actually think dollars look good almost across the board. And the Aussie had a key reversal today. So when you're looking at, the dollar as a whole, an inline number is going to spark some interest in, I think, dollar buyers and people that have been shorting the dollar. Plus you have PPI the next day. So what are your thoughts as CPI and PPI as we go into next week?
Well, I think the risks are probably skewed to a stronger dollar. And the reason being is that, you've seen future Vice Chair Jefferson and Powell, the two most prominent people there. Christopher Waller is very important as well. But the core of the Fed have basically pre-guided us that they want to pause. We've given a very strong hawkish outlook. So this skip is very much there. So that feels like it's the consensus trade. And therefore, if we were to see a weak CPI number, then it just reaffirms whatever the market's thinking, that we're going to get this skip. And potentially, a pause and a hawkish outlook. That said, if we were to see, a core CPI number, the market's looking for that to come down to 5.2%, above 5.4, that would be a surprise, and that would, cause a big move up and say, well, actually, do you know what? There is a possibility now that the Fed should hike, along with what we've been seeing from the RBA and also from the Bank of Canada. They need to hike. So, I think I'll probably look to reduce any kind of dollar positions going into that. But if you're to say to me, what is the more meaningful outfit? Well, given that the core of the Fed have guided to a pause, I think that it becomes more problematic to the market if we were to see a very hot core CPI number. That said, I have no belief that's going to come. I think probably the risk is that we get about 5.3%, which is what the Cleveland Fed nowcast model is looking at the moment. But they're also, the nowcast models are saying we're going to get 5.1% on the headline number there. So, again, will this affect the Fed's thinking? When the vice chair and the chair have kind of pre-guided us, it becomes less of a market event. But I think let's keep an eye on that one. I want to buy dollars, and I want to buy dollars on any weakness. Dollar yen looks like it wants to squeeze higher in the short term, in my opinion, here for sure. I want to address a question that we got from Duncan, actually on Twitter. And he was talking about the low volatility we've got in the VIX. And are we in sort of, 2018 regime effectively, where we saw consistently low equity volatility? what's going to push us higher? I mean, this is a pertinent question that we're seeing. So we just want to look at the volatility side of things. There's a question from Duncan on Twitter talking about the low VIX that we've got in the moment. This is the S&P volatility that we've got, 30-day volatility. And have we seen situations like this before? What's going to cause us to move out? A very pertinent question, and I sort of extend this out to other asset classes, Blake, where we've got FX volatility, implied volatility, 52-week lows. Gold volatility is a little bit higher, but it's still pretty low. Yeah, bond volatility's come down. But focus on the VIX because we're trading just about 13% on the spot VIX at the moment. Now, for me, this is a function that the close to close moves in the S&P have been very, very low. And that's what it is. So realised volatility, how markets are realising on a close basis, has such a big importance on how expected movement is going to take place. 70% or so of the pricing and the variance that you get in that is dictated by how markets are realising. So when you look at those close to close percentage changes being so low of late in the S&P, that's what the VIX to me is keying off. What's more important for me as a trader and a day trader is the idea about how you can have a look on TradingView, for example, at the average daily range, because that range is ultimately what you're trading, not the close to close price, which of course is what volatility is calculated off. So what are you seeing in terms of the VIX at 13%? Are you expecting to see a vol breakout, and ultimately, when does that come? What causes it?
Well, I'm not sure what causes it, and complacency is how I define the VIX right now. And really, you have extreme sentiment, extreme bearish sentiment in volatility. So that's kind of factoring into what I'm thinking as well. And we're obviously at levels we haven't seen in quite some time. So complacency also means that when volatility is down at these levels, you have to be extra careful with being long risk. It doesn't mean you should be short risk necessarily, but if you're long risk, like let's say you own the S&P or you own the NASDAQ 100, or you're selling dollars, you're buying buying copper or something like that, you have to be on guard, and you have to keep your head on a swivel when volatility is at this complacent level. I would expect that something is going to be a mover. And when you do see volatility, it's that day, Chris, that day when VIX is up 10, 12%. If it sustains that type of gain in one day, then you're going to get a follow through the following day.
What I would say is that, people are trading 1 or 0 day options now. There's 40% of the flow. So people are less inclined to use longer term volatility as a hedging mechanism. So that's kind of the VIX has it kind of lost its power of predictive of volatility that it once did, because so much volume now and the SIBO is taking place in much shorter term options. I think that's an interesting conundrum. But I mean, the idea of hedge, because you hedge while you can and it's cheap rather than the market forcing to you is one factor. But hedges cost money at the end of the day, and funds who have seen this market grind higher and higher and higher, are reluctant to put on hedges because they cost money and they're expensive to do so, or a bit cheaper now because the VIX is where it is. But hedges cost money, and I think that's something that people need to remind themselves. But this idea of hedging, because you can and it's cheap at the moment, rather than the market forcing you to hedge yourself, is something that definitely stands true here.
Yeah, all right, and I will reiterate that VIX is actually, for me, it's more of a tool in my toolbox. Multiple things that I'm looking at throughout the course of the day, and I use it to really as a confirmation tool, kind of how I'm going to position myself, especially if you get a wild move in the market. And it also, can cue me into taking positions off the table as well. Anyway, I know we need to move on. I think that was a great question from Duncan, and I got to mention this, everybody, all of our listeners. If you do have any comments or you do have any questions, look, we took that one right from Twitter. Jump in the comments section down below. I know both Westy and myself have been a little bit more adamant about being down there and jumping in the comments. So with that being said, let's move to our last topic, the FOMC, since we will be getting the literally 7 days from this moment, we'll already be past the FOMC. And so, Chris, I keep thinking of Michael Brown and Ryan Littlestone's skip, pause, skip. That's all they had on all their topics on it. So I'm going to say hike or no hike, yes or no. I know WERP, on Bloomberg had the probabilities yesterday at around 24-25%. I don't know where you see it right now, but with central banks like the RBA and the Bank of Canada already raising rates, they've already paused and they're raising rates again. Does that open the door for the Fed and Chairman Powell to say, we really need to do another 0.25%? Does this help open the door for them to take action if they really need to? It's kind of like, the door is ajar, so why not stick our foot through it? But I don't know if it's going to be those central banks necessarily. If we see the path of inflation that's finally going to reach the Fed's target over the course of the remainder of this year. But I want to look ahead into the Fed and ask you your opinion on how you're seeing the Fed and what you think they're going to do next week.
Take headline inflation. We're at 4.9% or so at the moment, aren't we? So we're expecting that to come down to say 4.2%. I mean, 4.2 from where we've been on headline inflation, 10% or so, is a massive drop. I mean,
it is.
The Fed will be sitting there going, yeah, look, things are moving in the right direction if we get a number like that. And I know core's moving at a slightly slower pace, but it's still coming down. And, the Fed will be sitting there, I think, thinking, Powell will be thinking, I'm doing a pretty good job here. I've got my critics out there. Of course he has. And maybe I had a hand in hand in creating those inflation, but it's going in the right direction and it's coming down at a good clip. So I think we can afford to go on a pause, but what we can't do is afford to let the market get into a euphoric state thinking that rate hikes are completely over. So I think he can definitely afford to leave rates on hold, but they'll make sure that the market is very much of the belief that their firm bias is to hike at some other meeting. So the market's pricing now. We've got 9 basis points of hike. So if you divide that by 25, that gives you a probability. I'm not going to do the math right now, but that's where you are. And so the other point then is what they're going to be guiding for in the dot plot projection. At the moment, the Fed funds is above their dot plot projection. So they're going to have to move their dot plots up for this year. They're going to look at their economic projections and again, this is going to be something we're going to be looking at. So this is the quarterly number. This is a really important central bank meeting. I think the market is going into it with probably low volatility relative to other Fed meetings, but I think this, for me, given the trajectory of inflation and expected inflation, survey-based inflation, I think that Powell will be thinking that he's done a pretty good job in getting it down there, and I think he can afford himself just a little bit of time now just to look at the lag effects that play through. So I'm in the pause camp for my sins. I'm sure there'll be people out there that say, Chris, what are you talking about? Tell us why you think that is, but I think very much in the pause camp. You quickly, Blake, what do you think?
I know real quick, just as far as the dot plots go, I mean, how's the market going to grapple with the idea, since they are projecting rate cuts eventually as we go into later into this year, into 2024? How about if the market has to adjust that? I mean, do equities take notice of the dot plots?
If they lift their dot plots up for next year, then they're going to do it for this year. Then they're still going to be projecting rate cuts. And I think the market's pretty comfortable with rate cuts next year. What they're not comfortable is rate cuts this year. They ain't going to happen. There's not going to be rate cuts this year in the US. And so I think the dot plots will tell you that there's going to be rate cuts next year as demand falls and inflation comes back to closer towards target. But it's a slow grind. But they can afford in 2024, in my opinion, if there is, even if there is a soft landing, they can afford to bring the Fed funds rate down to a more neutral setting and away from this highly restrictive setting that they've got at the moment. Those rate cuts doesn't necessarily mean that they're fighting a strong recession or anything, but they can take the foot off the pedal as we get closer towards the target and allow it much more neutral setting. So that's where I'm sitting on that.
Okay. All right. We could go on and on and on.
We could, mate. We could.
We could.
All right. Let's go to the setups that are a friend of mine. Let's go to that's the setup. Right. I'm going to talk about gold because we obviously see a lot of gold flow. It's arguably the most traded product here at Pepperstone. But
really? Wow.
Everyone loves it, to be honest. It's this non-geographical situation, whether you've got clients in APAC or in Australia, in Europe. I mean, people love trading gold. Good liquidity, good spreads. It's something that is certainly ingrained in our DNA. But Yeah, look, I think at the end of the day, you've got real rates now in the US, which are breaking out. That's something that the correlation with gold comes and goes. But I think we're starting to see it pick up a little bit right now. So obviously gold with no yield at all. When real rates are moving up, or the inflation adjusted bonds adjusted for expected inflation, the real returns are going up. Obviously, there's no less reason to own gold in that situation, and obviously we quite like the dollar. So we're right at this this key support level around 1938. We've seen a bearish outside day reversal playing through at these levels as well. So, a break through this, I think we get a test of that 61.8% retracement of that move up that we saw between March and May. But yeah, we're right on that support level. I think we probably break this. How do you see this, Blake?
I'm glad you bring that up. I think the 1930 level is really big. That's you say 1938, depending on what CFD, or you can just do the math, just look at the chart. It's that horizontal support, very big there. But and again, some people are trading front month futures, whatever instrument you're playing. The one thing I do want to point out is if you take the high from the high, I have to go look at my chart here, from March of 2022. And the one line that you don't have that I'm very, very much or very closely watching, you connect that high to the high on February 1st of 2023 of this year. Then if you break through 1930, 1935, or 1938, then the next place that you're going to see is that broken trend line. It comes in around 1915. And I just want to point that out because it is a level that, even though I'm very, very much concerned with the same level you're looking at, I just want to look one lower level just in case you get a reaction.
Do you know, I put the 200-day moving average, because you're always having a go at my charts and saying I leave things off. And I chucked on the 200-day moving average, and it's still wrong. It still can't please you, Blake. Jesus.
That's funny. That's actually quite funny. All right, well, let's move to the next setup. It is funny. Let's talk about Bitcoin. And this is Bitcoin. I remember reading this one blogger and what he had to say about Bitcoin years ago. And he's like, Bitcoin is a financial asset that's now woven into the fabric of the financial markets, which, I'm actually a pretty firm believer that Bitcoin's not really going anywhere from a product standpoint. So it's going to be around and be traded. However, I think it's a good trading vehicle. And you'll notice that low that was hit just 2 days ago when the SEC hit Coinbase and and the other crypto Binance or whoever it was, we tagged 25,300, and then we bounced up aggressively right into channel resistance. Well, that's also a 38% retracement. That's been a big. I can't tell you how many times I've talked about the $25,000 level over the course of the last couple of years, probably as much as you have and your staff.
Mate, but don't do it at home. Don't do it around the dinner table. Yeah. You've got to find your audience.
Your wife even knows that. Your wife knows that price. Anyway, I'm just watching a break below that price. It takes us down towards the 200-day moving average that Chris put on his charts today.
Yeah.
So that's what I'm looking at. Chris, what do you think of Bitcoin?
I think now that the AI has been all the rage and AI is here to stay. AI is not a bubble, in my opinion. It's something that's going to completely wove into the fabric. It's something that's going to stay with us for a while. But yeah, in terms of Bitcoin, it's not going anywhere. There's concerns around the platforms, as we've seen. But yeah, I just think it trades so well technically. It respects levels. It bounces off retracement levels. It does it pretty better than most markets, if not all markets, to be honest. So when you're looking at the technicals around Bitcoin, it's one that the scalpers can look at. Look at key levels, Fibonacci levels, or big horizontal resistance levels, and work off those levels. It's a beautiful market to trade, I reckon. Especially when it gets trending, it just goes and goes and goes. But it also just respects levels. So I love it as a trading vehicle. I think it's fantastic. But yeah, where does it go from here? I feel like that channel's got to be respected. I'll be selling strength at the moment, and that sort of commingles with my view on gold. Now I know that gold and Bitcoin are, the relationship comes and goes, and real rates and the dollar obviously has a factor. But yeah, I think that my view on that we're going to get a downside break in gold, I think it's probably true that we'd probably like to see more downside risks in crypto or Bitcoin at the moment. So we'll have to see there. Interesting one. I want to go to Aussie Swiss because talking about breakouts, love a bit of breakouts. Yeah, we've seen some downside in the Aussie overnight, but one chart that's looking quite ominously poised, there's no trade for me right now, is Aussie Swiss. We've got a beautiful double bottom. You can see the neckline of that double bottom just being tested at the moment. We've had the downtrend where we've seen that sort of series of lower lows and lower highs being taken out. Blake's 200-day moving average offers some upside. We're just above the double bottom target. But fundamentally, what's interesting is obviously we've seen the RBA swing into a consistently hawkish bias and giving us the view that they're going to do more, which would obviously take a positive view on the Aussie in that situation. But what's also interesting, Blake, if I have a look at the swaps market for it and what's priced in terms of rates for 2 years' time, at the end of April, we had 130 basis points of cuts being priced in Australia. That now stands at 0. So over the last month, we've now seen 130. That's one of the most aggressive repricing in G10 that we've seen, and it completely warrants this outperformance we've seen in the Australian dollar. Obviously China's in a slightly better spot. We've seen a 16%, 17% rally in iron ore futures. We've seen that in recent times. Copper's moved up to about 377 from 355. The Hang Seng's had a bit of a rally. It's sort of petering out a little bit. All these factors are very supportive of the Australian dollar. But we need this to work. And I've chosen the Swiss because, I think it's one that needs to complete, but I like it. And I think if we see a daily close above that resistance level, I think it can kick. How are you playing this?
Well, I'm not playing it, but I will tell you, I had my eye on the Euro Swiss. That was almost one of my setups today. Dollar Swiss also was in the running.
Dollar Swiss looks good.
I like Swiss. I like Swiss short right now, and I've kind of liked it for the last couple of weeks. And I've played it a little bit on the short side. Actually, I do have. Now that I'm thinking about it, I do have some short Swiss exposure. But the Aussie Swiss, after the RBA this week, and as you pointed out, it's pretty clear on a breakout. And will it be all Aussie dollar doing the work? No, I think it could be the Swiss doing some of the work as well and pulling some of the load.
I'll tell you what, just going back to Duncan's question about volatility, and vol means volatility, not volume. But when we're talking about Duncan's question around volatility, if we were to see the VIX rising, and obviously that correlates well nicely with FX vol and various factors, then I think the yen still, you can go and marry up the battle of the safe haven currencies. I think the Swiss underperforms against the yen. If we see the VIX pushing higher, I think play it from an FX perspective. I like being short the Swissy against the yen. I think that could be quite an interesting trade if we were to see vols pushing higher there.
I like what I'm hearing from you, Chris.
Good man.
No comment. All right. Let's move it to the last setup, which is copper. And this is called the simple setup. There it is. All right. So, Chris, what are your thoughts on copper here? I'm just kidding. Joking. It's simple. Let me lay it out for you. We just rallied and stalled and stopped at the 200-day moving average. The 200-day moving average also coincides with the 38% retracement, which is at 378.
Could you not put like your 200-day moving average and your horizontal different colors, mate? Because it makes it very hard to see.
But I'm making a point. They look all the same because they're right at the same spot. Previous support acting as current resistance, right at 380. Look, that's your line in the sand, guys. Above 380, it's bullish. Below 380, be on the short side. You know your risk. Play around the levels. Chris, it's super simple.
Does that mean it's going to appeal to me? Is that why it's going to appeal to me?
Look, thanks. Anybody can do it. Right. You can do it. Anybody can do it.
No, I don't know. I think this is make or break, isn't it? So the thing is China, right? They say you've had a nice reprieve. As you've seen with the Hang Seng, as you've seen with Dalian Iron Ore, all these factors, they've all rallied in unison because the market had got oversold because of a deteriorating China. And a fizzling out of the reopening trade. But we've now seen the Chinese authorities stepping in and coming out with stimulatory situations. Measures to improve the consumption of EVs. We've seen various targeted measures around property sales, reducing down payments, cutting agents' fees. They're trying to support the housing market because obviously that is the biggest feedback loop into people's perception of wealth in China and social security and social well-being. But it's not exactly emphatic. What we've seen is very targeted. What we want is a reserve ratio requirement cut. We've seen deposit cuts from the banks, but it's not overly stimulative. So again, the Chinese authorities are coming out. They are doing very targeted stimulus at the moment, but it's kind of a bit of a. It's not really it's not blown the market away after we've seen that rally. So we're going to need to see something a little bit more. I think China's the key there. we're going to watch that data flow as we go into the May series there. If the data continues to underwhelm, the market's going to expect more, and I think that's where your copper move comes from as well. So that's an interesting one. Anyway, good chart, nice and simple. Appeals to my keep it simple, stupid mentality, which is not a bad thing at the end of the day. KISS is always a great way to look in trading. Anyway, let's go to play of the day, and let's mix it up. Well, I come out with these simple trade chart situations, Blake, but I come out with the exotic play of the days, and they've done all right. Euro Mex last week was a good trade, and it's continuing to work quite nicely. I like the carry. We've been playing the long-short strategies in the equity indices, doing very, very nicely. And the one I want to look at today is a reversal, actually, of some of the ones we've done quite well on. And what we've got here is the US 2000 or the Russell 2000 small cap index, heavily weighted towards regional banks in the US, and we've divided that by the Nasdaq 100. Obviously, we've seen for people go and pull up a daily chart of the Nas 100, you can see that bearish outside day reversal. That needs to kick now. If we see a lower low, that would confirm after the strong rally that we've seen throughout this year that perhaps the sellers have taken some control, and perhaps it's going to start consolidating, if not move to the downside as people take profits. A lot of that's going to be dictated to by the rate cycle. Are we in a new rate cycle? Are we going to see higher bond yields, which makes these cash flows of these high-tech businesses coming under pressure? Are people going to start jumping ship a little bit there? But what we can see there is the Russell 2000 arguably having a significant outperformance after a long period of underperformance. Has this got more legs? I think it has. So I like being long the Russell 2000 here and short the Nasdaq. It's an aggressive trade because everyone loves the Nasdaq, but everyone loves the Nasdaq for a reason. And I think there's a lot of money that can come out in the short term. Not giving up on tech longer term. I still think it's fantastic. I think the AI scene is real, but I think as a trade, I think there's some more short-term outperformance from the Russell relative to the Nasdaq. So I'm playing that as a ratio trade there.
Awesome, Chris. Thank you so much. And by the way, I have to hand it to you. Those plays have been awesome, exotic, and not so simple. All right, let's go into something that you want to talk about aggressive. Let's go into my play of the day, and this is literally my play of the day over the next within 24 hours. I was talking to our Forex analytics community about this. It's a trade that I have live orders out. I'm not short, but I am looking to short. And I'm actually looking to short the guppy at that rising trend line or the 161% extension just above 172. Reason why, divergent relative strength. I think the yen is going to start to show some signs of life with the reversal that we've seen in the Nikkei. I think the Nikkei's got a few days of air coming out of it. I think the yen's going to strengthen on the back of that. I think the pound looks a little heavy. Range bound. I think it could trade back down to support with the dollar strength. So you put all that together, you got the pound yen. Notice the divergent relative strength on the breakout ever since the end of May. So the last two weeks of a grind higher, relative strength is completely diverged, and I think that's going to allow us for a move, possibly back down to 170, 172. By the way, I'm not sure if I said 172. I just want to say I have an order out for the next 24 hours to short at 175. That's what I meant to say. Yeah. Targeting around 172.
Do the Forex analytics community sit there and go, Blake, you're just making up words with the guppy like I did once, or are they actually saying, yeah, we've all heard about that?
The guppy is real, Chris. It's a real thing. It's a thing. It's always been a thing.
Yeah, and I believe you, mate.
At least for us in America.
Just on Scottsdale. Yeah,
maybe down my street.
Yeah. Anyway, that's all we've got time for today. Some great setups there from Blake. Some overly simple ones from myself. Anyway, we'll see you guys next week for more of the trade off. Hit the like button if you've stayed watching this far. We appreciate that. And obviously, if you can leave a comment as well, Blake and I get to it as soon as we can. We appreciate that as well. So thanks very much. We'll see you next week.